Hey everyone, Douglas here, and welcome back to the channel. Today we're going to discuss inflation, the inflation numbers that came out earlier this week on Wednesday, beating consensus 6.2% year over year from last October, and the initial response from not only financial media, but a lot of market makers I know, or market participants I know that I follow on Twitter and whatnot. The main concern here is some sort of either kind of runaway inflation or stagflation event that seems to be, or at least is worried to be, on the horizon. And in this video, I'm going to essentially lay out my argument that I don't see that happening. And it is something I am certainly not planning for. And I just don't think the data is showing yet. And there's no reason to really believe that that is going to be the outcome. In fact, I think probably by mid-2022, maybe even early 2022, I think the narrative is going to be disinflation. And I think already we might be seeing some data to point that way. But the objective of this video is to kind of go over exactly what the risk is with inflation and how that ties into the broader financial economy as a whole. And then I have a few other things that I want to throw in there as well. Let's do this. Before we get into the real details here in terms of what it is I'm seeing in the data and kind of how to demonstrate why I don't think we're close to stagflation by any stretch, we need to understand really like the base case of what MMT is as a theory, right? And MMT really begins with this observation that the deficit, right, that is the money that the federal government is spending into existence that is not taxed back, so the money that's left out there is equal to the total private savings. Okay, that is the kind of the base identity, the accounting identity that all the rest of MMT as a prescriptive theory starts with, right? And if you understand that, then you can start to bring in some observations about what inflation might be doing, because there is a demand for savings that the private sector has, and the federal government can either meet that demand by spending money or not meet that demand. And if they don't, then the private sector will go into debt, and that's how it'll grow the economy. But as long as that demand is being met, then the economy won't go into further debt. Well, the issue is that savings amount, right? So I mean, let's just say you had $100,000, right? And that's what you had saved for, whatever event it is that you needed to do, right? You wanted to buy $100,000 worth of stuff, and so you save that $100,000. Well, if inflation were to suddenly double, right, then all of a sudden that $100,000 will only buy half of what it would have had inflation not doubled. And that is the big risk to the real economy, is that the new money coming into the economy isn't going to be able to purchase what it used to because of that inflation. And that is really what stagflation is, right? It's that even though we still will run deficits, even though the swimming pool, if you will, to use that analogy, will continue to get more and more water in it, so there's more and more savings, that those flows continue into the private sector savings, you're effectively getting even though you have a technical deficit, in real terms, you actually are not in deficit, but instead in a surplus, right? Because the deficit is not outpacing the inflation at that point. And that is kind of the crux of what I'm going to get at here in the next chart that I'm going to show you, is that we are really a very far ways away from that point occurring yet, where inflation is actually starting to put us into some sort of surplus as opposed to a deficit. So I'm going to switch over to this chart right here, which I put together, and it's a little crude, but it's going to get the job done to kind of show exactly and demonstrate exactly what it is that I'm trying to get after here. And what I have is, so what I track this every single day. I follow the daily treasury statement, and I calculate what I call the fiscal flow. And what the fiscal flow is just the amount of money every single day that ends up into the private savings, into the financial sector as a whole, through the channel of government spending. And then what I use it for, again, for the purposes of trading and investing, is I go ahead and smooth that out over time and average that over a year to get the average new dollar every single day that is heading into the new economy, or heading into the financial sector. And so what you can see is I have both and then for this chart, for this purpose, since the CPI data is only released monthly, I've averaged the daily average, into a monthly sum, and then plotted it on the chart here. So this is the average daily sum of the month plotted on the chart. And then the orange line is the inflation adjusted, with the blue line being just the average monthly sum of the daily flows. And what you'll see is from the 2006, when this data is begins to where we're at all the way up until today, or up until really kind of June-ish of last year, you can see the essentially one-to-one correlation. There's no break between the inflation adjusted, very few breaks between the inflation adjusted and just kind of the nominal flow. Up until, again, that kind of June break, and we were starting to see this begin to break down, and there's a very distinct breakage between the two. And the point I want to point out here is certainly the inflation is eating away at kind of at real growth. There's no doubt about that, right? We're lower than we would have been had inflation been at zero. But because of the massive fiscal response following the COVID crisis and the ensuing financial crisis that happened right after, to just the continued flows that we continue to see to this day, we are light years away from any sort of fall off of overall fiscal flows. In other words, we're not going to see a deficit switch into a surplus at any time soon. And with the passing of the new infrastructure bill, that seems even further away than it has in quite a while. So a stagflation situation seems very, very far away. And ultimately, like I mentioned at the start of the video, and I went through this in detail in the recent macro update on my Patreon page, I'm starting to see some signals that, in fact, the first kind of dominoes are starting to progress into a more disinflationary outcome, likely in early 2022, maybe by mid-2022, it'll be quite pronounced. But the point being is, in terms of the current fiscal situation and what you define as kind of stagflation, we are very far away from that scenario playing out. The fiscal flows are just too strong right now, and I think the inflation will eventually resolve itself. From everything I can see at this point, the inflation is certainly supply side, and it is not a monetary phenomenon. I've talked a lot about inflation and what drives inflation a lot on this channel, but just in summary, I'd want to see two things really happen to get any sort of runaway inflation. The first one, which is kind of happening, is the sort of feedback loop, such as Social Security and anything that's pegged to inflation continues to rise year over year. That would be a channel in which new money at a higher rate is entering into the economy. So to a certain extent, that is a risk. But the other biggie, and the one that just isn't happening, is you'd really need interest rates to start to really get pushed up, and you'd really want the Federal Reserve committing to a regime of higher and higher interest rates. Now, that could happen, but at this point, the Federal Reserve has come out and said, no, we're going to keep interest rates low. And again, I've talked about this in prior videos. I think the majority of economists, definitely the Federal Reserve, has this backwards. Lower interest rates cause disinflation. Higher interest rates push inflation higher because of essentially the term structure of prices, that it prices the future cost of doing business higher and higher. And so at this point, we're not seeing that. And that's why I feel pretty confident that, in fact, the inflation we are seeing is what would be defined as transitory as opposed to monetary, because of that function right there. Now, granted, it's been a long transition, but we also had an unprecedented situation with the pandemic and then the fiscal response following. So at this point, I'm not seeing anything that would indicate that this inflation is going to be in any way runaway, nor am I seeing anything that says that we'll enter some sort of stagflation situation where we're actually getting growth to decrease because inflation is so high that essentially it's putting us into a surplus in the sense of a deficit. So that is kind of my at least assessment from a financial side and what the impact might be on the financial economy. And one point that I wanted to finish on too is that the sort of inflation that we're getting, or at least what's happening because of the outcome of that inflation, is quite interesting. This was posted by I saw this by Joe Weisenthal, who is on Bloomberg, the Odd Lots podcast, on his Twitter page, and he pointed out from the income and poverty, the report that the census puts out every year, I believe it's every year, from last month, is that the benefactors of the inflation, if you will, or of the fiscal spending that we did have was actually the lowest income earners. And you can see right here in terms of post-tax income, share of aggregate income by percentile, it was the lowest three quintiles that actually grew the most from 2020 to 2019 because of the fiscal response. And I think it is exactly what an MMTer would expect, that if you do direct fiscal stimulus to the lowest quintiles of income earners, that you're going to end up with the inflation being a benefit to the lowest income earners. And I think that is why you're seeing quite a few in the finance and banking industry really complain about the inflation that we're seeing, because unlike the asset inflation that we saw for the better part of the last 10, 15 years, instead we're seeing income inflation getting driven by the sort of fiscal response that we've seen, that's very much in line with what you'd expect from an MMT framework. So I thought I'd at least just point this out, that there's no doubt, and I don't want to diminish the impact that some of the inflation, especially the food prices and some of the shortages of food, goods, and services, are definitely impacting people's lives. But because of that direct stimulus, the income of the lowest earners has been impacted. So unless you're like me and you wasted your stimulus on meme stocks and shit coins, it's still real income, right? And that can be used to offset the increase in the cost of inflation. So I did want to point that out, that again, hopefully we'll never have to go through a sort of fiscal response post a pandemic again. But at the very least, the test has been done, and when you do use fiscal stimulus to stimulate the economy, and it's a direct payment to the lowest quintile, it's going to help them, even if the offset might be a little inflation into the future. It's at least benefiting those who kind of need it the most. So I thought I'd at least end on this note. All right, so I'm going to go ahead and wrap things up here. But before I take off, if you are an active trader, active investor, and you like what I'm doing here, and you like that combination of technical analysis and the MMT framework, you want to get access to everything I have, all my weekly updates, all my trades that I make, and you just want to get a deeper dive into the world of MMT macro and technical analysis, by all means, check out my Patreon page over at patreon.com/MMT macro trader. I'll leave a link in the description below. But other than that, I will go ahead and call it a video, and we'll talk to you next time. Bye-bye.